Basically, what I'm saying is that call buying is not a one-shot deal. You don't just buy a call and forget about it. You undertake a call buying program. You buy calls, hopefully they go up in value, you sell them at a profit, and as the market goes up, you buy a higher strike, and then if the market goes still higher, you sell those, you at a profit, and so on as the stock ramps up in value. And you do this over and over and over again. Now, you do have to get stocks that cooperate to do this, of course. The equivalent to buying a call, of course, is to buy the underlying stock. But you know the downside of that, the stock costs a lot more. On the other hand, when you buy the put, it only has a limited amount of life, but it's much cheaper than buying the underlying stock. So that's the most basic of all. Now, in the book, what I've done is I've taken some recent examples that are real examples, real stock prices, real premium prices for the calls, just to give you an idea of what you can do. And on our strategy number 1, the call buying example, I picked out Cisco Systems. The symbol is CSCO, and it was trading at 1994, so it's virtually at 20. So I'm saying that you could buy a July 20 call for $1.25 now. This is early March, and July is 3 or 4 months away still. So you're paying $125 to control every 100 shares of Cisco with this option. Your cost, you know it, it's $125 a call. So your break even at expiration is the strike, 20, and what you paid, $1.25. So it's $21.25 is the break even. Anything above $21.25 in Cisco prior to expiration on the third Friday in June will mean you have a profit on this strategy. And of course the profit's unlimited because Cisco could go to infinity prior to expiration in July. So that's the most basic and the one that people are most familiar with. Let's go on to strategy 2, which is put buying. Now, puts are the reverse of calls. They give you the right to sell the underlying. So what kind of market would you want to do this in? You want to do it in a bear market. You want to buy puts because you think the market's going down. The put gives you the right to sell the underlying at the strike prior to expiration. And the risk is the same as in buying a call. It's 100% of whatever the premium is. So the potential exists from the strike down to zero. Obviously, the stock can't go below zero, and there's unless you have a bankruptcy situation in the time you own the put, the stock is going to have some value. Even if you do have a bankruptcy situation, the stock won't go to zero. So break even is the strike minus the premium. Whatever you pay for the premium to buy the put, the market's got to go below that by expiration for you to make money. The advantages are you get the high leverage and higher profits, and large profits rather. And the thing about the pricing in puts I should mention is that puts typically don't cost as much as calls, even if they're at the same strike. And the reason is investors tend to be bullish, not bearish, and they'll typically pay a little bit more for a call, even if it's a 50-50 situation where it could go up a certain amount or down the same amount. The put will typically not cost as much. So you should take that into consideration. You'll see when we start buying and writing straddles here that the put is invariably less expensive than the call, unless, of course, it's in the money and the call is not in the money. You've got the risk, same risk whenever you buy options. The premium is gone the minute you pay for it. It's not coming back unless the market moves in your direction. So the market must decline below the strike to gain profits. It's highly speculative, and you don't want to buy them when they're too far out of the money. Now, when a put is out of the money, when the strike is below the market price. So if the market's at 20 and you're buying a 15 strike put, it won't make any money unless the market gets below 15. To be in the money, you'd have to have a 25 strike put or higher than the market price. The problem with buying a deep out-of-the-money put is the market's got to decline a lot for that to have any value. And there again, as in the call buying strategy, you want to take profits to recoup the investment and buy lower, roll down in this case. You're buying lower strikes as the market declines. The equivalent, of course, is short selling stock, and we talked about that. You need to borrow stock, you need an uptick, and if the market goes up, you're liable for the whole amount. You buy a put, you're only liable for the premium and no more, regardless of how high it goes. Now I have charts in all these. This is the first one. We've got charts for each. If you look in your booklet there, you'll see there's a put purchase chart. And what this shows you is as the underlying asset price declines, the value of the put increases. On the other hand, the fixed cost of the put, the maximum amount you can lose is absolutely fixed to the premium, and that's why the line is horizontal at the bottom there. But you can see that as the price declines, you make more and more money by owning the put. Now, here again, I picked an example, and this was just not picked in terms of I had an idea the stock would go up and down. It was just a stock at a given price and a put at a given price, just to illustrate the concept. And in this case, I took United Technologies, UTX. The market was at 57.87, and I bought a May 55 put for 80 cents. 80 cents translates into only $80 for the option. Now, the put, is it in or out of the money? If the market's at 57, the put's at 55, is it in or out of the money? It's out of the money because you would never sell a put at 55 if you could get 57 in the market. So it's $2.87 out of the market. The break even is at 54.20. So once the market goes to 54.20, you've made 80 cents on the transaction, and you paid 80 cents, so you're at break even. And of course, it profits below that. The further it goes down, the more money you make. And again, as a practical matter, you probably don't want to hold the put to expiration. You probably want to sell the put as it becomes more valuable. Even in a market that's declining, and I'm sure you know this if you've traded stock, even if the stock is very, very weak, what will happen is bargain hunters, bottom fishers, will come in the market and bid it up after there's some big breaks. So if you get one of these big breaks, rush into the market, sell the put you bought, took the profits, and then sell lower strike puts as it continues on down. Now in strategy 3, we're going to talk about doing 2 different transactions as opposed to just one before, where we just talked about buying puts, one, or buying calls. Now we're going to combine options with stock, and this is simply an insurance play here, and it's buy stock, buy puts. Now, I mentioned before that you wouldn't think of driving your car out of your garage without having insurance on the car. You wouldn't own a home without flood, wind, fire insurance. But practically everybody who trades stocks doesn't have the position hedged unless they take strategies such as this. This is a conservative strategy just in case to protect you with a hedge if the market were to go down when you buy the stock. So the technique is to buy puts as insurance against a stock decline. The environment you want typically in this is a bullish environment. You want the stock to go up in value so that you can make money on it. But if it doesn't, you don't want to lose money on the stock if it were to go down. And I can't tell you how many times I bought stocks that went down where I should have owned puts, and I didn't, and I wish I had, because the put will protect you in that case. On the upside, what do you have here? You've got an unlimited potential for profit on the upside because you own the stock. And what it does by owning the put is it locks in the selling point in a down market. So you buy 100 shares of XYZ, you buy an XYZ put at the money put, say, and if the market were to go down, whatever the decline is, the loss on the stock is offset by the increase in value of the put. The break even is where the gain in the underlying offsets the put premium cost. So whatever you pay for the put, you got to make that back in the market. This is a conservative strategy because you've only have the added expense of buying the put. The problem is, what if the market goes up sharply and you still own the lower strike put? In that case, let's say, for example, you buy the stock at 20, you buy a 20 strike put to protect yourself to the downside, and the market soars to 30. Well, the put, of course, won't have much value, but the stock will. If the stock were to decline now back to 20, only then would the value of the put kick in. So what I'm saying is, in this scenario, you'd want to think of rolling up the put to a higher strike to protect yourself in the case of market adversity. You've got a paper profit, protect it by rolling up the put to a higher strike. So think of this strategy as purchasing insurance with a deductible, depending on what the cost of the option is.